Hello and welcome to the Crypto Club and Digital Assets Weekly Catch-up on Zoom. Hey, Jack. Hello. So is your interest in what, Bitcoin or altcoins or what then?
Bitcoins at first. Yeah.
Bitcoin's mainly, okay. Hey, and we're joined by Emma as well. Hello, Emma.
Hi Gary, how are you?
Welcome to the party. Hello there.
Yeah, first time.
Indeed. Don't worry. Jack's not been on before either. We've got Dan with us. Dan has been on before. And we've got Eric who's joining us as well. Eric always is really interesting, talking about what's going on in the States, that kind of thing. So for those who've not been on before, we never quite know what we're going to end up talking about. But it does tend to be around Bitcoin, crypto, blockchain, DLT, all this kind of stuff. And we're joined by Eric as well. So good morning, I guess, Eric. Hello there.
Yes, indeed. It's my late morning.
Yeah, it's an early start for you.
Yeah, well, actually, these days I'm waking up much earlier. I used to like to wake up at 10:30, but these days it's more like 7 in the morning.
Okay.
You've seen one of these? It's called a Whoop. It's got three sensors and it is educating me about my sleep patterns. So I'm making modifications to my lifestyle in order to get better sleep. I'm listening to Huberman a lot and learning about the relationships between sunlight and temperature and sleep. And so I'm getting up much earlier these days.
Excellent. Okay. The one thing I learned about Whoop a while ago, I know someone in New York who got a Whoop, and he's really into exercise and that kind of thing. So I just Googled it, and then ever since I've been blighted by constant adverts for it on every social media channel. So I'll stick with my Fitbit for now, whatever it's called. So what's new in the crypto world then, Eric? Anything happening for you on the West Coast?
We're doing Blast 2023 in Dubai. So there's a whole bunch of the liquidity providers. There's almost 9,000 of them by now that are getting together there, and we're announcing the 2.0 version of TLN, which is the sort of new final structure for the network. So that's exciting. We had an initial thought about how to grow it and incentives and these kinds of things that we knew were not long-term sustainable. And then we had a thought about how to transition that. And so now we're, 9,000 people's enough that we can do this transition.
Okay, so for those who've not been on this before, maybe you'd like to quickly share what it exactly is that you've developed.
So this is TLN is, you can find it on the internet as thelastnetwork.com. It's basically a network of liquidity providers. A liquidity provider is an individual or an entity that provides liquidity to a liquidity pool. And liquidity pools are basically smart contracts that hold two assets and you can trade against them. So they obviate the need for a marketplace where if you want to sell something, you have to find a counterparty, someone who's willing to buy it, and vice versa, because now every trade is made against the pool, and the pool can make the trade because it's sitting on both of these assets. And so what's interesting about pools is that they're not only provide liquidity to markets, but they also provide a pricing mechanism. So the pricing discovery processes that we've had for 10,000 years are all of a sudden no longer necessary. The pool tell you precisely what the price is at any point in time, despite, or taking into account the size of the transaction. So issues like slippage, for example, are now computable. So we've put together a network of guys who provide liquidity into these pools. And one of the things that's really amazing about it is that when you provide liquidity into a pool, the liquidity is perfectly safe because it's in the pool. it's not going anywhere. No one can withdraw it except you, because you put it in there with your private keys, etc. So since the pools charge transaction fees every time that somebody wants to trade, they charge you $1 or whatever it is, and the pools have no use for money. What they do is they take all of these transaction fees that they collect and they pay them out to the liquidity providers. So if you own 10% of the pool, and the pool just charged $1 for a transaction, it gives you 10 cents. So that yield is based on a zero risk investment. We typically call that an alpha in the financial industry. So it's pure alpha instruments, right? So this is a very attractive proposition, especially in a world where there is so much risk that people are wondering, what do I do with my money? I don't even want to leave it in the bank. It's so dangerous, right? And I certainly don't want to invest it in stocks or anything. So what do I do with it? And the answer is, well, put it into a pool. And then you'll get a yield that's far better. And in order to incentivize people and to grow the network quickly, we allocated a certain amount of capital as a marketing budget, and we are paying 4% per month in addition to whatever the pools yield, right? So that's a 48% per annum return. That's pure alpha. And so that's really worked out quite well for us. We did the first year, which just closed, and now we decided, we talked about it, we decided to do it for another year. So I rolled over my position, and I mean, when you consider like investments into even crypto, the incredible volatility of crypto, this seems like a no-brainer. So that's what we're up to, and the transition that we're making from TLN 1.0 to 2.0 is essentially a change in the model, where the way that it currently works is when you put liquidity into a pool, the pool gives you pool tokens, right? So imagine that you have VOW, let's say you have 90 VOW tokens and 90 V dollars in the pool, and then you come up and you put 10 of each, so that now it's got 100 of each. So clearly you then own 10% of the pool. So before you make your investment, the pool will have issued 90 pool tokens. And when you put your liquidity, it issues an additional 10, so that you now owe 10 of a total of 100, right? So these tokens represent your ownership in the pool. And the way that we do it is we commit the liquidity providers to a 1-year lockup period. So they take their LP tokens and they stake them for a year, and that's how they get the 4%.
So Eric, a quick one then. How does that compare to what people would know as yield farming, linked in with a token-based liquidity provider, and what you're describing is, I think, an automatic market maker in effect?
Yes, it's called AMM as well. And a lot of yield farming is a very convoluted process, where you have to buy one thing and then stake it, and then you get something else and you stake that. And I mean, there's a lot of smoke and mirrors. Our process is very, very straightforward, right? You can provide liquidity to any pool you like on Uniswap, including our pools. If you provide liquidity on our pools, you'll get LP tokens just like everybody else. Great. And then you'll just get whatever the fees are that the pool provides. We just say, if you take your LP tokens and you stake them for a year, we'll give you 4% per month, right? So it's a very easy to understand. There's no great complications. But one of the great things about this is that we've structured it as a multi-layer marketing network. So if you take $10,000 of your money, you put them in, and you're happy, happy pink. Then what happens is you come to me and you go, hey, Eric, I'm doing this thing. It's amazing. And I go, wow, I love it too. So then I come underneath you, right? And that means that I still get my 4% and I get the pool yield, but you get an override on top of me. And if I bring somebody else in, I get an override on top of them, and you get an override on top of them, up to about 10 layers deep, right? So all of a sudden, you your initial intention is to get guys underneath you, what we call the front line. But then after that, after you've got 10 guys, your intention is really to promote your guys to get guys, right? And so now you start forming events. And this is what's happening is we're doing a lot of these events because like one of the German guys so we have like 9,000 people on the network, and they're mostly German, Austrian, Swiss. There's some Swedes in there. I think there's even some Mexicans in there.
So it's probably worth picking up, Eric, because there's some comments coming through at the moment saying this is MLM and pyramid. So that is actually correct. However, multi-level marketing, if there is a product, is legal. There's nothing wrong with that. And if you look at some products that you can buy, not non-crypto necessarily, they are multi-level marketing, and it is perfectly legitimate to do like multi-layered commissioning on a pyramid type basis, as long as it's not like a Ponzi type thing, which is where you're feeding in the money from one group of people to keep paying the others, which you're obviously not doing.
That's exactly correct. So what you can't do, and obviously it's for the fact that it is unsustainable, is take money from take fresh money and pay off old money, right? Because then you're tied into growth rates. Can you expand fast enough to keep feeding the older layers? And most of the time the answer is no. And then people end up getting ripped off. But in this case, you come in and you take your money, you put into a pool, and it's perfectly safe. So you're never going to get ripped off, right? The fact that you're getting this yield, and that you can get the yield across 10 layers, just means that our marketing budget is getting spent out much more quickly, right? But we're willing to do that, so no problem there. Okay. So so I was just mentioning one of the German guys was actually, I'm in LA now. I just came back from Japan and Korea, and one of the German guys was here. We had lunch, and he's like doing 500,000 a month out of his little part of the tree, right? So it's there's a point at which you really can sort of back off, right? Now you're just organizing events and stuff.
So lots of things going on. That's really interesting. Just wanted to open up because I'm conscious we've had a load of people who've joined us. Got Livio, Jack, Gabriella. Gabriella, I guess you're still in Ireland at the moment. And we've got Elena in Ireland as well. Dan, hi Dan. I don't know if anyone wants to join. If any of you got any immediate questions, if you want to grill Eric or anything, I think there's some.
I've got a question. So this is from someone who probably understood about 15% of what you just said over the last 20 minutes.
Okay, I can explain anything. So ask them.
That's most of us, Dan. Don't worry.
So to clarify, in my knowledge, it's the lastnetwork.com. Is that what you said?
Yes, I'll post it here in the chat so that there's no.
Amazing. Right. So basically, what you're doing with your money, the money, is you are providing liquidity.
Yes.
Is that for people to leverage? Is that how it works?
That's correct. So so we have a family of pools, right? And they're all indexed against the VOW token. So we have VOW against Ether, VOW against USDC, USDT, VOW against V dollars, V pounds, V euros, etc. Yeah. So imagine that you're in Europe and you've been earning V pounds, and you decide to spend some of the V pounds to pay for travel to the United States, right? So you can go on V Travel, but V Travel accepts V dollars. Actually, now we accept V pounds, but just for the sake of the example, right? Or let's just say that you fly to America, and here you have to spend V dollars. So what you do is you take your V pounds, you send them to the V pound to VOW pool, and you get VOW, and then you take the VOW and you send it to the V dollar to VOW pool, and you get V dollars, and now you can spend them. So we're effectively doing Forex, right? There's two stages in the process, one, and it can be automated and all that. But the point is, that trade doesn't happen unless there's liquidity in the pools.
Yeah.
Right. And because you are using essentially a Forex service, you pay for it, right? And that payment goes to the guys who provided the liquidity.
Okay, I'm with you. That cleared it up a lot more. Thank you very much.
It probably helped a lot of other people listening into that as well, Dan. And that's what I always say, that there's no such thing as a stupid question apart from the one that you don't ask. Because
Exactly.
invariably you'll say, and I do it all the time, I sometimes say, I'm being a bit dumb, can you just explain this? And everyone else on the call goes, yeah, I didn't get that either. So that's good. Anyone got anything else for Eric on that while he's on? Okay. Well, that means either everyone completely understood it, or they're now Googling it and they're taking a look in the background, or they're going, what on earth was that and what have I come on to here? So that's really good. Thanks for sharing that, Eric. It's always interesting anyway. I don't know, anyone got any other stuff that's going on that they'd like to talk about at the moment, or we're just here to learn and listen from each other? Hey, everyone's gone quiet. Elena normally waits until the end, and then she asks something like, just at the beginning of the conversation, you said something. So I don't know. Emma, yeah, go for it, Dan.
I'm just
All right.
Go for it, Dan.
I was going to ask you, I've seen a couple of news articles about ordinals.
Mm-hmm.
And I just wanted a brief summary of what they are and what they do. I feel like it's a smart contract kind of space.
I don't think it's smart contracts, but I'll open up to anyone else who actually knows what ordinals are. I think I know what they are.
Basically, ordinals are NFTs. And this is actually kind of an interesting topic because let me explain for the audience a distinction that we make in the kinds of things that that exist out there. We have in English, we have words for things that are countable and things that are non-countable. For example, people are countable, or grapes are countable, but sand is not, right? Or sugar is not. So those are quantities. So what makes a thing a quantity versus not, right? And the answer is a word called fungibility. If a thing is exactly the same as the next thing in value, even if they're not the same in structure or in other ways, but they can essentially be replaced for whatever the use in question is, then they are said to be fungible and they're a quantity, right? So we can talk about the number of grains of sand, but we can't say how many sands, right? How many hair, it's how many hairs or how many strands of hair. Actually, incidentally, that's a distinction that is really disappearing in the US. Nobody says, like people say, they treat like people and other countable things as if they were quantities. But in any case, so if you imagine that you have, let's say, diamonds and you have gold, 1 ounce of gold of a certain fineness is exactly the same as 1 ounce of gold of the same fineness. So you have two things and they're completely fungible. But two diamonds are not fungible because they're different in their structure and in their value, right? This one is a diamond cut and this one is an emerald cut, and this one's D clarity versus, E clarity or whatever, they differ. So not exchangeable. So Bitcoin is kind of nominally fungible. And what I mean is that you should presumably be able to take one Bitcoin and just convert it for another, or just treat it the same as the other, except that Bitcoin has a history. Each Bitcoin has a history. So to begin with, there's no such thing as a Bitcoin, right? A Bitcoin is really kind of the summation of a bunch of outputs in a model called UTXO, which stands for, I forget what it stands for.
Unspent transaction outputs.
Thank you so much. It's been so long since I think about this stuff. So what happens is when you say I have a Bitcoin, in fact, what you have is you probably have a quarter of a Bitcoin and an eighth of a Bitcoin and a tenth of a Bitcoin and half a Bitcoin, And all together, these unspent transaction outputs come up to a Bitcoin, and you say, I have a Bitcoin, but there's no such thing really. Which means that since you have an unspent output, which means that you received some amount of Bitcoin from someone, you received it from someone, and therefore one unspent output is not like the next because they differ in their origin. So one of the things that happens is companies like Chainalysis, for example, they look at a wallet, and they look at all the streams of Bitcoin that compose the contents of that wallet, and they say, this stream came from this exchange and ultimately from stolen funds. So your Bitcoin is now somewhat tainted, right? And there's questions about whether or not you could be held responsible for owning this Bitcoin because you are in effect, in some way related to someone who's doing something illegal, and you're at the very least suspect now. So this all goes to say that Bitcoins are not truly fungible. And this is a very sad thing because money is much more useful when it's truly fungible. There are tokens out there like Zcash and Monero and other kinds of technologies that hide the characteristics of the transactions. So they provide they guarantee the integrity of the monetary supply. Means to say that people can't choose money.
Eric, can I suggest? I'm going to suggest taking this up a level, so that I think Dan might understand it in a slightly different way. Okay. So if you think about how Bitcoin works, is that Bitcoin is basically like having bank account balances on the blockchain. Okay, so this is always really funny when people say, "Oh, I've got Bitcoin in my ledger or my Nano or whatever." You've actually got a private key which references somewhere on the blockchain. Okay, so the blockchain is just a big database distributed all over the place. Every time there's a transaction with Bitcoin, when you're saying, Gary pays Elaine or whatever, there's a transaction written to the blockchain. And on that transaction, there's I think it's about 20 characters free, which is just free text. Okay. Now, a Bitcoin, we talk about a Bitcoin as though it's a single thing. It actually isn't. It's just an entry in a database, an account value. But it can split down into 1/100 millionth of a Bitcoin, and that's called a Satoshi or a Sat. Okay, so an ordinal is effectively a Sat, so a single Satoshi, where you're using that 20 characters or whatever it is to reference something off chain, and this is why the idea of a token comes in. So, say for example, you've got shares in a company. And each share, instead of it being physical certificates, is simply represented by one Satoshi. That says Satoshi number 0xAB1111 is this share, and Satoshi 0x2 is this share, and so on. Then what it now means is that you're able to use the Bitcoin blockchain as the ultimate ledger of transactions of those shares. And it's held at a Sat level. And they're known as ordinals because it's like the lowest unit of measure that you can have. So Bitcoin ordinals tend to be tokenized representation of ownership in some way, where it's using a Satoshi to represent the ownership. Because even though a Sat is tiny, we can still transfer the value between each other. And so, as Eric was saying about NFTs before, a lot of NFTs are effectively just electronic receipts, the bill of ownership type thing. And so you can use Sats or Satoshis to represent ownership of stuff, and that's what tends to be Bitcoin ordinals. Then you've got the whole thing, well, that means you could use an ordinal to represent some graphic or some image or some Bored Ape Yacht Club image type thing. And this is where ordinals start getting a little bit controversial, because they're falling into that whole NFT space where there is a fair amount of fraud and hype and all this kind of thing going on. So that's...
And it makes the Bitcoin network even less fungible, right? Because now you have like tags for it. Now, one of the things that I think is interesting is that you can put the message, which could be like a URL or something, into the transaction. So it means that the unspent output has that data attached to it. But as soon as that Satoshi goes somewhere else, it's in a different transaction, and that message is lost. Not lost because it's still in the history, but it's no longer attached to that Satoshi.
So Dan, you were saying before about smart contracts and that, how a lot of NFTs work. If we take a look at on the Ethereum blockchain, for example, a lot of NFTs use a smart contract kind of template standard known as the ERC-721 token standard. And it's just it's a computer program, right? But it's a computer program that follows a certain format in terms of inputs, process, output, that kind of thing. So that's all a smart contract is. It's a little computer program that controls effectively access to somewhere on a blockchain. Whereas a Satoshi is not programmable as such. It's just an entry. So it's almost like you could have like a load of share certificates with share certificate number 1, 2, 3, 4, 5, and so on, represented by individual sats. So that's where they're actually different from smart contracts, because originally Bitcoin was not a programmable blockchain. It was simply a ledger of transactions, and it was designed that way. Whereas Ethereum, since 2014, I think it is, has had this programmatic capability.
Actually, I'm going to disagree with you there.
Go on. Yeah.
Bitcoin was always programmable in a language called script, which is it's a stack language, and it's very hard to program, and it's very limited in what it can do. But you can actually write very small programs around the transaction.
Yeah. I always get into the semantics of whether scripting is programming or not. And then I have arguments with people about when they say that they code in HTML, which is not a programming language, but a markup language. But that's another conversation for another day. Dan, hopefully that makes it a little bit less mysterious what we're talking about.
Yeah, no, I do think it is it's a confusing subject. However, it's cleared up. I've got my notes down, so it's something I can look into and understand a bit more. But it's a good foundation, definitely.
Yeah, I reckon a lot of people who come onto these calls actually then go away and spend the evening on YouTube and Google. What on earth were they talking about? And what are they? So that's good. Okay, cool. Right, anyone got any other questions that they want to throw in there?
Can we please clarify something else that Eric mentioned earlier? Eric, you said that, well, because we can prove previous ownership of any Bitcoin or fraction of a Bitcoin, you said that if it came from an illegal source, it could be slightly tainted.
Yes.
This particular fraction, for example, that I bought, that I own, can be a little bit tainted. And that makes Bitcoin non-fungible.
Correct.
So, and if we think in the same way, but say that someone bought some Bitcoin that previously belonged to a famous person or a celebrity, will it make this particular Bitcoin or fraction of Bitcoin more valuable than other fractions?
Things being, people being what they are in the way that they assign value, absolutely could happen. I mean, I can tell you in the over-the-counter markets, what they call virgin Bitcoin is priced more highly, right? Which is to say, Bitcoin that was just freshly mined. So, in other words, Bitcoin that has no history will command more money than Bitcoin that's been floating around.
Yeah, it's a little bit like, it's funny because we talk about money being fungible because £10 or $10 is worth, £10 or $10. However, if the serial number on the note is in some way unique, if it's got loads of zeros in it or something, then it will command the premium. Or, as you say, if you know that a particular note was previously owned by somebody, it's a bit like people who buy a car because it was previously, I think there was a Land Rover that was recently sold that was a former Prince Philip, so former royalty type thing. So the vehicle carried the premium because of who previously owned it. For those who don't know, we're talking about Bitcoin and how you can trace things and that. I'm just showing up on the screen at the moment. This is the Bitcoin blockchain, and this is just all the transactions going through at the moment. This went through, I think it was a few minutes ago. And here we can see, here's a transaction going from this Bitcoin wallet here, which is BC1, PZV, blah, 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 blah. It had 0.0315 Bitcoin in it, and then it transferred out to all of these wallet addresses. So what you can do is you could click on one of those wallet addresses, and you can see what other transactions that wallet has had. So this is how you can ultimately trace through and see the source and destination of every, and this works with Bitcoin, it works with Ethereum, it works with a number of other open blockchain protocols as well, that it allows you to actually trace the origins of certain cryptocurrencies. And as Eric said, that means that if some part of a Bitcoin or whatever has been used in dubious activities in some way, then it's kind of tainted, which is strange, because if you think about a euro or a dollar or a pound, the very fact that that might have been involved in a bank robbery at some point never counts. It's always treated as legitimate, and this is why sometimes some cryptocurrencies nominally carry a higher value. So Eric gave an example of what are known as virgin Bitcoin. So these are Bitcoins where you can see they've just been mined, or they've got no history. You can see that they've come from a Bitcoin miner. It's a reward from that. So they definitely haven't been tainted in any way. The other interesting one is that various law enforcement agencies every so often sell off Bitcoin that they've seized in some way. So the very fact that you're buying it off, say, the FBI or the US Treasury or whatever else, now kind of gives a clean bill of health to those particular Bitcoins. So if you can trace it back and say, well, this has come from the FBI, then it's obviously legitimate. And so they can carry a premium, although in actual fact, they're usually sold at a discount because people buy, I'm trying to think, the FBI is actually one of the largest holders of Bitcoin, if I remember correctly, because they seize loads of crypto from people. And then every so often they hold an auction and they sell the Bitcoin off. Surprisingly, because those Bitcoin now carry a kind of a premium because they're nice and clean, they actually sell them off as a discount because they sell them off to whales and that kind of thing who just buy them all up. So hopefully that clears it up, Elena, what we were saying on that.
Yeah.
I posted a link to the Chainalysis website where you'll see a bunch of graphs, and Gary, you can pull it up on screen if you like, but
yeah.
It just shows the kinds of analysis that is possible to do on the Bitcoin network and on Ethereum as well.
Yeah, and this is where companies like Chainalysis and Elliptic, it is another big one as well. They actually do a lot of this analytics stuff to track and trace the origination of coins. And if you say had some crypto that's been stolen, for example, then they can potentially show where the crypto has gone to and trace it to the exchanges and that kind of thing. So yeah, Eric shared. Doesn't seem to be working too well on my screen at the moment, but it's showing the kind of the way they have traceability, where they can see crypto from a miner going out to different wallets and that kind of thing. So that's really interesting. And the thing as well, that this is where, in fact, I don't think I was screen sharing that, wasn't I? This is where it can be quite interesting that also it means that you can see where stuff has come from and where it's gone to. But also you can do all sorts of other analysis of like trends and that kind of thing of where cryptos are going to and that kind of thing as well. So it's really interesting. So law enforcement agencies, tax authorities, they all work with the likes of Chainalysis and Elliptic to track and trace things like where cryptos have gone to in that. This is where the term, you may hear the phrase pseudo-anonymous comes into play as well. Because if you think about when I was showing that blockchain actual transaction before, where it said it was going from wallet BC1, blah, 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 we don't actually know who owns that. However, the exchanges, because they do know your customer and anti-money laundering and all this kind of thing checking, quite often they keep registers of what those wallets relate to in terms of human beings. And so this is why tax authorities and federal authorities and that can sometimes track and trace transactions. And this is how you get things like sanctions lists, where they actually ban certain crypto wallets from being involved in transactions because they've been proven to be either to do with terrorism financing or illegal countries or sanctioned in some way. So there's a thing called OFAC, which is part of a US government thing where they do sanctions lists about people, companies, politically exposed people and that kind of thing. And if they track
the Office of Foreign Asset Control.
That's it. Yep. And so they actually have a list of people and countries that people in the West are not supposed to trade with. And so, Stefan's mentioning about, a bridge between Monero and Bitcoin. So Eric was mentioning before about Zcash and Monero. These are what are known as privacy coins. So they are designed in a way to obfuscate the original owner of a crypto and the destination. And so what some people will do, as Stefan mentioned, is that they'll sometimes maybe take a Bitcoin transaction, run it via another crypto like Zcash or Monero to obfuscate its kind of history, and then convert that back into another crypto in some way. The idea being that it then hides the original ownership of things. But then the likes of Elliptic and Chainalysis, that they get involved, and sometimes there are ways around that obfuscation as well. Yep.
So from a commercial perspective, non-fungibility is actually undesirable, because imagine that you have access to the payments of your competitors. Then you know who they're buying from, and you know how much they're paying for stuff, right? So now you can go and negotiate, or you can position yourself properly, because it's possible to trace the payments and get a complete picture of who's doing what.
And that's one of the things that sometimes people don't think about, is it's what's known as metadata analysis. That it may be, if you're looking on a blockchain that's got loads of transactions, you don't necessarily know what those transactions are about, but you can start doing some quite clever inferencing. So what used to happen a few years ago is that if you saw certain wallets became active, say 4 p.m. UK time, then in all probability that was going to be someone on the west coast of the USA waking up and doing some trading or something. Likewise, if it was 10 p.m. UK time, that would be someone in Australia. So you could do what's known as heuristic analysis, that you can start inferring connections. And then if you can actually get someone's wallet address, which is what a lot of law enforcement agencies do. So this happened in, I think it was Sweden about 3 years ago now, where they had some suspected drug dealers. And so an undercover police officer went in, bought some drugs, paid for the drugs in crypto. He now knew that the wallet address that it went to was owned by this particular criminal. And so they could then trace it and track it and everything. So this is where the whole thing of traceability can be good and can be bad, depending upon who you are and who you're trying to protect yourself against.
So how could traceability be bad? Because to me, that example sounds like say, for example, if there was a drug deal that was going on in the modern world, they'd probably use a boatload of cash in an elastic band, which is not traceable.
Yeah. So I always say, first of all, I'm not offering financial, legal, or taxation advice or criminal advice. But I always say, if you want to go money laundering, that the best way of doing it is use dollar bills in a suitcase. because that is pretty untraceable. And actually, even then, it isn't necessarily, and there are ways of doing that. So the concept around, should law enforcement agencies be able to do traceability? It's always argued, well, if you're not doing anything illegal, then why would you not want that? Okay, which is valid, but we've all got curtains on our bedrooms, okay? And that's because we want privacy in some way. Even though we're not doing anything illegal, we still want some privacy. So the fact that, Elena and I have done a transaction in some way, there might be nothing illegal about it, but I don't want Emma to know about it, or I don't want Eric to know about it. And this is where the whole traceability thing, if it's for legitimate law enforcement, then perhaps that's okay. But sometimes not always. Stefan, you've got a question, or you've got your hands up.
Yeah, so I wanted to ask something regarding traceability. Have you researched about the secret token? It's a small project. It's a company who tries to make like a blockchain similar with Ethereum, and in the same time have secret assets, like the same as Ethereum, but you can also have them in a secret way, so nobody else would find out. If you have any ideas about the way the structure works and if it's feasible or possible? I researched a bit, but not too much. I was more curious about this.
Okay, it's not one I'm aware of. The more mainstream ones for privacy enabling tend to be the likes of Zcash and Monero. Eric, you've heard of it then?
I actually have quite a bit of experience with it. I've been keenly interested in this, and I've been following its development for some time. There actually has been a lot of controversy over the name, because most people think that because it's called a secret network, you can do secret transactions like you can on cash, and that's not true. They don't. They do have public information on the transactions. The reason it's called a secret network is because a smart contract is capable of holding a secret, and that is a really, really powerful thing. I'll give you one example under which it really revolutionizes the world of crypto. If I have, let's say I have Bitcoin and I want to buy some Ethereum. So the problem is that there are two different networks. So I can take my Bitcoin and sort of wrap it, right? On Ethereum, there's a thing called WBTC, which is wrapped Bitcoin. And the way that works is I send my Bitcoin to an address, and then automatically the same number of WBTC tokens get minted on the Ethereum network and delivered to some address that I own, so that my WBTC is now equivalent to the BTC that I surrendered. And I can go the other way as well. I can burn my WBTC and get Bitcoin back. The problem is that the mechanism that accepts my Bitcoin is run by human beings. It's centralized, which means that someday they could basically run off with all the Bitcoin, and now the WBTC tokens that they issued are basically worthless, and I've been ripped off. So it's not a good solution. But the problem is that in order for so let's just say then we have people and we have smart contracts. We cannot trust people. We know that for sure. They steal, they cheat, they lie at every opportunity. Smart contracts never cheat, never lie, never steal, because they have no volition of their own. They're just code, and we can review the code and say, yeah, this is fine code, right? But the problem is that if we're going to have a smart contract, let's say on the Ethereum network, that wants to be able to produce a Bitcoin transaction, it needs to sign the transaction, which means it needs to have the private keys for the Bitcoin network. And the way that Ethereum and really all of the existing blockchains work, all of the data in a particular smart contract or in transactions must be available to all the nodes in the network, because they need to be able to replay the transactions. So that means to say that you cannot hold private keys in a smart contract, because they're supposed to be secret. If they weren't secret, then everybody, all the nodes in the network would have access to the Bitcoin, right? And so it would for sure get stolen. So the secret network, what it does is it allows you to hold a secret inside of a smart contract, which means that I can now put the private key for a Bitcoin account inside of a smart contract that I can trust. And I can now send it tokens that are on the secret network, or really on the Cosmos network. And when it receives them, it can burn them, and then it can write a Bitcoin transaction, sign it, and broadcast it to the Bitcoin network so that I receive my Bitcoin. So now I have a decentralized way of wrapping coins, and as long as I can do that, I can now do cross-blockchain transactions in an atomic way, in a way that is done programmatically and that I can trust, right? So that is enormously powerful. By now, there are actually other technologies that have solved the problem of cross-chain atomicity. That has been a kind of a holy grail for a long time. So so that's a little intro on that.
I was going to offer as well, the other thing to consider when we talk about like privacy and transparency and traceability and everything is that when we start introducing crypto where you can trace back its origin only to, let's call it a dark coin, whether that's from the secret network or Zcash or Monero or whatever, you've got a problem in a lot of countries about a thing called source of funds. So you have to be able to prove the origination of where the money's come from. Now, one of the problems with privacy networks and privacy coins and all this kind of thing is that you can't actually prove that where you've got this crypto from or originally was legitimate. And that can cause some real problems. And I'm sure you're all familiar, certainly if you're in Europe, it's a real pain at times trying to connect your crypto wallet or your exchange to a bank account, because the bank at the slightest hint of crypto will freeze your account or whatever. And if you try and buy something, I know someone who tried to buy a house with crypto, and the lawyer just wouldn't have anything to do with it. He said, no, we need source of funds. We need to prove where you've got this from. And he said, well, it's crypto. I made loads of money out of crypto. No, that's not good enough, even though, bizarrely enough, you can actually trace crypto's origins on the blockchain, which actually makes it far more traceable than cash, that kind of thing. So this is why a lot of fiat-type financial services companies don't like going near crypto, and they definitely don't like going near any crypto that's been attached with any privacy-type things. So, Stefan, ask away. Or
So what I want to ask is also regarding privacy. I don't know if you work in the field of networks. I want to ask, when you basically do a transaction via an internet, you use your normal computer, desktop, whatever you have, you send the cryptocurrency, you open your wallet, you send your, Bitcoin or Ethereum. That transaction you send, it should go via the protocol IP, right? When when you send packages.
Not necessarily.
Okay.
So
well,
one
it
of
depends on your how you're physically connected to the rest of the world.
Yeah. So what you can also what you can also do is, as an example with Bitcoin, you could use a paper wallet. So you can print out a QR code which has got a private key to access a wallet address, and you can physically hand over that piece of paper to somebody else. So that's the equivalent of a bearer bond, as it's known.
Yeah.
So that takes you totally off the network.
That's smart. I never thought about this.
There's an amateur radio layer that you can use to do transactions on Bitcoin as well.
Yeah. There are mesh networks as well. And if you take a look at what's going on out in Africa at the moment, there is a project which is it World Mobile Token, if I remember correctly, where they've just launched their own mesh network in, I think it's Zanzibar and somewhere else in East Africa, where they've actually set up balloons or static balloons, as they're called, which rebroadcast, and they've effectively created their own non-telephony-based network in order to transfer crypto, which is quite effective. So they've got a token called WMT around that.
If you do it in this way, my question, the reason why I ask is you could be off the network, because I know that FBI, for example, and probably like the British government, they are able to track, if they have access to the network, they are able to track your transaction and what you do via the IP protocol. So I was wondering if you can do this, but you answered. There's also another thing with the satellite. Do you know if that would be a secret one? You can use an antenna.
Yeah, you can use a satellite network, but then you're probably going via IP again. But what you can do is you can use a protocol. So some of you will be aware of having a VPN, so a virtual private network, which isn't good enough these days. But what you can use is what's known as ZTN, which is a zero trust network, and that is effectively a temporary channel through which a transaction can go, and it's a peer-to-peer, point-to-point channel that exists purely for the existence of that transaction. So if you understand how networks work and how you've got like packets of data which goes through routers and onto networks and all that kind of thing, they're quite traceable. Even if you use something like Tor, which is the onion router, if you're a law enforcement agency or whatever agency, and you've got some of your own computers as part of the Tor network, then you can use that to track and trace things, which is where, if anyone watches the series Mr. Robot, which should be mandatory watching for anyone who's into privacy and that kind of thing. One of the episodes that Elliot, who's like kind of like the key guy in this, he realizes that his local internet cafe has got phenomenal internet speed, and he can't figure out why. And then he realizes it's actually being used for illegal activities, and they're running a whole load of Tor network endpoints. And of course, anyone who's got the endpoint, so that last computer between the network, which is invisible almost, and the person, now means you can track and trace who it's all data's going to. So I think it's well worth watching that series. So there are ways around these things, but you're right that most people, if they use the traditional thing, if they go onto a laptop across a broadband provider, across an IP network, so a VSP or an ISP or whatever, a service provider in some way, then quite often the IP address is traceable in some way. But there are ways around that, which I'm not going to talk about at this stage because
this is not a YouTube channel.
No, but so some of this does appear on YouTube sometimes. So we've only got 5 minutes left. So I just wanted to open it up. Anyone got any final questions or anything? Because we've covered some really interesting stuff there, quite detailed. Yeah, Stefan, go.
Yeah. So what do you think? Like when I studied this for like a lot of time, like from 2017. My question is, I also look at the emotional state of people. What do you think it's prone to be like biggest thing in this market? Because I was thinking blockchain games might be something. The gaming, the gaming category might be a big thing. I'm thinking probably NFTs. But what do you think, in your opinion, that would be the biggest thing this market? Sorry, I've been a bit late, and that's why if you said I couldn't see it.
So the gaming space linked in with tokens, where you can do things like, if anyone's into computer games where you can buy assets like outfits or land or anything like that, there's already tokenization of that stuff going on. But I think that's tiny compared to what I'm now beginning to see a growth in, which is what's called the tokenization of real world assets. So this is where we're finally getting to the point where you might have things like property, real estate, gold has been mentioned already, where that's run using tokenization in some way. And in that case, we are only just at the beginning of that journey. Because crypto at the moment is worth, what is it today? $1.4 trillion, I think, is the market cap. Compared to traditional finance, that's tiny. that's nothing. So if you start thinking about stocks and shares, if they were tokenized, or if treasury bonds were tokenized or anything like that, the opportunity of that is far, far bigger. Dan, go for it. A couple of minutes left.
Right. So you said tokenization of real world assets.
Mm-hmm.
Now, usually, since I've started coming to these meetings, we've mentioned insurance every time.
Mm-hmm.
So if a real world asset can be tokenized on the blockchain, does that make it much more likely to be insurable?
So all a token is, effectively, it's a certificate of ownership, right? So what it does mean is that you can change the way you have a register of ownership in some way. And that's where it's really interesting from both crypto and an insurance point of view. So in the UK, there was recently a new act of parliament that went through, which actually I called it the Blockchain Act. And I've actually forgotten the right term for it now. It was some like Electronic Digital Assets Act or something. Go and check out on Google. Google Lord Holmes and Blockchain Act. And Lord Holmes, for those who don't know, he's in the House of Lords, an incredibly knowledgeable guy who is blind. And I've said before now, his dog knows more about crypto than most people in Parliament. And he was behind a lot of stuff around this new Act of Parliament, which is around digitizing assets in some way. So that introduces a whole range of opportunities for insurability, because it means you've now got evidence of ownership in an agreed immutable digital form. So as you'll know, down from an insurance point of view, you can only insure something that you own or that you've got a financial interest in. Well, this would be a way of proving that you have that. So that's definitely an interesting thing on that. Folks, I'm conscious we're kind of at the end of the hour. It's been a bit of a whirlwind tour today. So, Eric, thank you for sharing a number of things, both in terms of what you're working on, your project, but also with showing some of the insights as well. And I think hopefully everyone enjoyed that. It was certainly interesting. As Johannes says, traceability could make it more insurable, which is true. Although it's interesting, there's about 3 major traceability projects that were insurance related, which have all failed in the last 12 months for some reason. So it's a real shame. So anyway, hope everyone's enjoyed today's session. Do come again next week. We hold these every Sunday evening, 7 till 8 p.m. Do come along and join, do ask questions, do join in, and have a great day. Bye for now.